Personal finance presentation, savings services. Prepare to get financially fit by practicing personal finance. We're going to start off taking a step back, thinking about the types of services. Then we're going to focus in on the category of savings services and then take a look at some particular saving items. So we have the types of financial services, including cash availability services, payment services, and then we're focused here on the savings services, credit services, investment services, and other services. We're focusing in on the savings services. The categories that we're going to be breaking out for the savings services will be the regular savings, the money market account, the certificate of deposit or CD, and the U.S. savings bonds. We're going to break those out in a little bit more detail now. Starting with the regular savings account, this is probably the one that we're most familiar with. Because they pay int and keep your funds easy to access, they are a great option for placing money you'll want in the short term or to cover an emergency. So these are types of accounts that are often in your financial institution where you have your checking account, such as your bank, and they're often going to be coming coupled with the checking account so you could put some money into the savings. Putting money into the savings could be better than holding onto it in the checking account because you might get a little bit more of the interest. However, this type of savings account is often still generally quite liquid, meaning you can still take the money out and access it quite regularly or readily, and therefore the interest rate you're going to be receiving on this kind of savings account will generally not be as high. So you're trading off when you're thinking about these savings options generally between the level of risk you might have in order to generate revenue, but when you're looking at savings accounts, the level of risk is usually lower than other types of investments like stocks and bonds, and then you're trading off whether or not your money is going to be locked away, meaning how much access do you have it when you need it, meaning if you put the money in the bank for a longer period of time, that's good for the bank because remember what the bank does, they take your money and they in essence loan out a portion of it, keeping a reserve so that they can then generate interest on it. Now, it's a lot easier for them to do that if they can basically be assured that you're not going to be pulling your money out for a longer period of time. So the more security they have, that they know how long the money is going to be in the bank, the better ability they can plan their basically loaning process. Therefore, that added security usually results in a higher interest rate for us. So the question then on the savings of very safe kinds of investments is, how liquid is it? How much access do we have in it? Trading off between that and basically how much we're going to get in terms of an interest rate. Now remember, if you're in a time when the interest rates are quite low, then you can look at this whole thing and say, well, man, the interest rates are really low no matter what I do at this point in time. But remember, you want to have an idea of these things because you won't always be at a time when the interest rates are really low. Interest rates over someone's lifetime will increase and decrease, and even if the rates are low, then you still want to maximize, of course, the rates that you can maximize, have your money work for you as best you can while still lowering the risk as best you can. So in exchange for liquidity, the savings account offers, you'll generally earn a lower interest rate than more restrictive saving instruments and investments would generally pay. So other kind of investments would, of course, generally pay higher than a savings account, which you can pull the money out of basically any time. So the amount you can withdraw from the savings account is generally unlimited, which is part of the reason you don't earn as much interest on it because that's what you're trading off, the liquidity versus the higher rates. Next, we have money market accounts. So money market accounts, they are generally offered by banks and credit unions. Money market accounts generally pay higher interest rates than regular savings accounts. They often come with debit cards and limited check writing privileges. Many banks also offer high yield or high interest checking accounts, which may pay better rates than money market accounts, but which also impose more restrictions. So you're going to be trading off generally the restrictions versus the higher returns once again. We then have the certificate of deposits, the CDs. These are the ones where you're basically locking up and adding a substantial amount of restriction to the access of the money, oftentimes in exchange for a higher rate of return. They generally pay higher interest rates than the best savings and money market accounts in exchange for leaving the funds on deposit for a set period of time. So with a CD, you're basically saying, I'm going to put my money in for a set period of time. It might be a year, it might be 5 years, it might be some set of months, 6 months or something like that. And I'm not going to touch it for that period of time. And for doing that, because you're not going to touch it, leaving it in the bank, giving the bank more security, they're generally willing to pay a higher interest rate. So now you're trading off a higher level of restriction for the money, because if you do take it, and you can possibly get access to it, but you'll be penalized in essence most of the time if you were to take it out of the CD early. So in exchange for that, then you'll typically get a higher rate. So when you're looking at CDs, then often you're comparing something like a CD, because you're locking your money away and it's not quite as liquid, to other types of investments, possibly like stocks and bonds. At that point in time, there's going to be pros and cons with the stocks and bonds. When you put money into a CD, it's usually going to be the more conservative or less risk that would be involved, given the fact that you know exactly the interest rate that you're going to be earning because you agreed on it when you put the money into the CD, although that rate is typically lower than the possible rate that you can get in more risky type of investments, such as investing in the market, mutual funds, stocks, and bonds. So they are safer and more conservative investments than stocks and bonds. So that's usually your trade-off there. Do I want to put money into the CD, or do I want to be putting it into the stocks and bonds? It kind of depends on your risk portfolio and what your portfolio looks like. We might talk more about that in future presentations. CDs offer lower opportunity for growth, but with a non-volatile and guaranteed return. So that's, of course, the trade-off with the CD. You've put money in, you've agreed to what the return is going to be already, and you've exchanged for that the possibility that you might get a bigger return on other types of investments which are more restrictive, such as stocks and bonds, but you have less risk. So that's going to be the trade-off with it. Although you lock into a term of duration when you open a CD, there may be some options for drawing early if you encounter an emergency. So if you have certain kind of emergencies, you might have more access to the CD. I wouldn't rely on that kind of thing. If you had to take the money out of the CD and pay a penalty on it or something like that, then you might want to look into those options. And then if there was an actual emergency where you're willing to give up, the penalty to take it out or something like that, fine. But if you think you're going to need the money, in the future, then you probably don't want to lock it down into a CD if you think you're going to be needing it within the time frame that you have the CD. There's often strategies that you can use to try to put your money into a CD if you want to use that type of tool while still having access to it fairly periodically. One strategy being to ladder, what they call laddering the CDs, so that you put them in a series of CDs that have dates of maturity that will happen periodically throughout the year, so that you will have access to your cash periodically, even though you've kind of locked it away and hopefully getting those larger returns for doing so. Next, we have U.S. savings bonds, a form of government debt issued to American citizens to help fund federal expenditures. So this is going to be debt basically that's coming from the government. And due to the fact that it's coming from the government, you have a couple benefits. You have some benefits related to that. They are sold at a discount and mature to their full face value. They do not pay regular coupon interest. So like other bonds that pay coupon interest, either yearly or semi-yearly, oftentimes these do not. There are Series EE bonds are sold at half the face value and mature in 20 years. And then we got the Series 1 bonds are adjusted for inflation. So these are types of investments that are typically thought to be quite secure. They're quite secure because they're going to be backed by the U.S. government. So if there's going to be a problem or a default in some kind of area, you would think that the bonds would be one of the more secure options due to the fact that they are issued and supported by the government itself. Of course, you have similar kind of trade-offs due to that, meaning the fact that they are going to be more secure type of investments typically means that you may not be getting as high of a rate of return as you might get in other investments. So you're always thinking about this trade-off that you're going to be having between, how long do I have to restrict the money in order to get a higher return versus the higher return? And then what's the risk related to the investment related to the higher return? If the risk goes up, that doesn't necessarily mean that you have an expected return, the possibility or probability of the return being higher, but returns that have a higher expected probability then usually will have more risk related to them. In other words, the risk itself is not the thing that's going to increase the higher rate of return, but types of investments that typically do have a higher expected rate of return will generally have the higher risk, and those are the types of trade-offs that you're making within your portfolio, considering those risks and reward, both in terms of the individual investments, and you want to think those risks and rewards in terms of your portfolio in general, so you can take them in. And when I say expected return, we say expected return because there's a probability, in essence, calculation in terms of what you think the return is likely to be. But when you're looking at an expected return, the fact is that you could have a loss because you're kind of thinking, you could think of it as basically an average type of return. When you're looking at most of these kind of investments, you're thinking about a return which is a lot more secure because they're basically under the category of, in essence, savings, and you're making an agreement that's fairly concrete about the types of returns that you're going to be getting in these types of investments. When you put money into stocks and bonds and mutual funds and stocks and so on, then it's more likely that you might have a greater return, but you haven't really locked into exactly what that return will be. And of course, you could have a loss with those types of investments.